This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and my good friend Bud Hettinger always introduces the show. It's like he's live in studio with me, but he's not. He recorded that a while ago. Anyway, we are a radio program / podcast. Once we do the radio show, we flip it over to a podcast version and put it out on all the various social media channels. It usually takes us a day to do that, so that'll happen tomorrow on Monday. In the meantime, we have, as we usually do, much to talk about here on the live program. It is, of course, Super Bowl Sunday, which always makes me happy, or makes me happy a whole lot more than it ever used to, because, of course, as a young boy growing up in Maine, I always liked the New England Patriots. So the first 30 years of my life, it was tough sledding, that is for sure. I think they made the Super Bowl one time when I was in my 20s, and that was when they got annihilated by the Bears. The Bears. And, well, see, Mike Nelson's will turn 18 in March. So pretty much pretty much his entire lifetime, he's only known the Patriots getting into the Super Bowl 9 times out of his like 50% of the time. 50% of the time in his lifespan, my New England Patriots have made it to the Super Bowl. That's pretty impressive. So, of course, we have to spend some time on Super Bowl Sunday talking about the Super Bowl indicator, so we will cover that. Also, there's some proposals floating around up in Washington that are, in light of the many states that are putting together their own sort of versions of retirement plans. I think we talked about it on the program. I don't know if it was last week, maybe the week before. You've got a lot of states that are rolling out their version of the IRA, which in my mind is just a bunch of silliness. It also is a good way to kind of create confusion, particularly when, such a vehicle already exists on the federal level. And so you're starting to see some movement in Washington to focus on these various states that have come up with these options of enforcing employers to offer retirement plans and making that automatic, or options where you can go into a marketplace, if you will, and find a plan for you. So you're seeing some movement in Washington to try and get in front of this before we get a patchwork of different states offering different options. So we'll talk about the proposals that are pending in Washington. Some interesting stuff in there, particularly involving required minimum distributions as well. And then, of course, we'll talk a little bit about the markets. My goodness, if you haven't been paying attention, and understandably, it's easy to not be in the loop when things go well in the market, isn't it? Right? I mean, it's easy to not be in the loop at all because, well, that's just not what the folks in the media like to talk about, is when things go right. They only talk about when things go bad, and and try and convince you that they're only going to get worse from there. And the problem is that usually doesn't happen. And you can look no further than what the market has done so far this year to come very quickly to that conclusion. It, in fact, was the best January in over 30 years for the broad-based markets, which gained 8% for the month. So if you're keeping score, the entire decline for last year, which was around 6 or 7%, more than offset by January. So that's great. Why that would be bad news for you is if you followed the herd in December. Because in December, there was a record outflow from stocks and stock mutual funds. So hopefully you didn't follow the herd. If you did, then you got trampled. If you didn't, well, then, my goodness, then what you're seeing on your year-end statement isn't the right number. Perhaps you check out what the numbers are now, and you will be pleasantly surprised. Some interesting economic data going on out there this past week as well. The job situation, even with the government shutdown, and I mean, it just underscores just how much private industry kind of shakes its head at government. Because when you look at the jobs report, it was widely speculated that everybody would kind of retrench because of what was going on with the government shutdown. And the reality is that private sector businesses sort of shrugged that off and just kept on hiring. The 100th straight month of increased employment in January. That's just unbelievable. And you're actually seeing wage growth, too. So that is even better. For many years, there was job growth, job expansion, without a whole lot of wage growth. Year-over-year wage growth is at 3%, which obviously is pretty decent. But certainly January, a very, very strong month. And it's fascinating that the media doesn't really talk about it. But the other part of it is it just shows you how much things can get resolved unexpectedly. So during the course of the end of the year, we were talking a lot to people about the risks that were out there and that were really weighing on the market and contributing to that decline in the months of November and December. And there were two, and we said this in our January communication to our clients, and it was the Federal Reserve, and it was China. Federal Reserve still seemed to, in November and December, be on track for continuing to raise rates. They were also doing the unwinding of quantitative easing to the tune of $50 billion worth of treasuries each and every month. And so that was having a sort of a doubling effect, if you will, on the impact of those higher interest rates. So the other issue, China, with obviously the trade dispute, either one of those issues were major issues that were weighing on the market. Now, the China one still very much exists out there, although there has been some conversation over the past week, which helped the market to a good week this past week, to that ultimately there is some progress being made in those conversations. But the more important thing that just sort of happened out of the blue is on January the 4th, okay, so literally after having all the Federal Reserve meeting in December, having the rate increase, going through all of that, literally like 2 or 3 weeks later, the Federal Reserve chair on January the 4th comes out and basically says, okay, now we're going to completely change the approach here, and we are, in fact, going to adopt one where we're just going to be more patient before raising interest rates. And so now, almost overnight, as a result of those comments and a continued formulation of their plan at their meeting in January, almost overnight, the market's gone from thinking that there was going to be 2 interest rate increases to now expecting there to actually not be any. And so that also helped to generate a very, very strong January. And it just underscores the unpredictable nature of how events can play out relative to the stock market. And just think that's a great example, right? You're coming November, December, it's all about the Federal Reserve, it's all about China. But ultimately those were issues that were going to have some form of resolution. It's just interesting that the resolution happened quite unexpectedly as quickly as it did. And so consequently, the market reacted very, very strongly, very, very positively. And unfortunately, for the vast majority, or certainly a large portion of folks out there, there was a mass exodus out of stocks and stock mutual funds in December. I think record $75 billion left. And so that's unfortunate because that means that those people did not see the kind of recovery that we saw in January. So literally you go from the worst December in 70 years to the best January in 30 years. And folks, that's something we talk a lot about on the program. The very nature of volatility is that some of the best days are usually clustered around some of the worst days. And that's the piece that people forget. And it's certainly the piece that the folks in the media certainly do not talk about. Along those lines, we'll hit 2 different things when we get back from this break. First of all, the latest study out of the folks at Dalbar. Dalbar is a big financial research firm, and it underscores kind of those concepts we were just talking about, where a lot of investors left the market in December only to see January be as positive as it is. The gap is dramatic when you look at the analysis and the research that is done, and then we've also got to do a follow-up of that USA Today writer who retired last month. We talked about the headline that he's most known for is saying that the market's going to continue to go down back in 2002. He's got another more recent headline that we thought we would share with you just to connect all of the dots on that. So we'll do that. We'll also take your calls, 407-916-5400, toll free 1-866-916-5400. This is Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. Open lines at 407-916-5400. Toll free 1-866-916-5400. A couple of weeks ago, we were talking about this longtime financial reporter who works for USA Today, announcing his retirement after 20 years. And the article that he's most noted for is basically saying the market's going to, never recover. And he wrote the article like the day after the market hit the very bottom back in 2002. This is how consistent he has been, though. We'll fast forward to the December 31, 2017 issue of USA Today. And he wrote an article that said 18 stocks to consider for 2018. All of the 18 names are seen rising 25% or more, according to analysis. That was the title of the article and the lead-in sentence. 18 stocks to consider for 2018. All of the 18 names are seen rising 25% or more, according to that. That just seems like, Guess what? 17 of the 18 stocks lost money. And if you had put an equal amount of money into those 18 stocks, you would have lost 26% for the calendar year 2018. Folks, if you think that going it alone and buying some individual stocks and taking that kind of approach and relying on what you are reading in the papers, it's not going to work. It's just not going to work. I mean, can you believe that? The dude, by the way, he wasn't a new writer. He'd been working for USA Today for 20 years. Writes an article at the end of 2017 featuring 18 stocks to consider for 2018. All of the 18 names are seen rising 25% or more. And the reality is 17 out of 18 lost money, not up by 20. And if you had put an equal amount of money into all 18 stocks, you would have lost 26%. Folks, there are so many ways to get distracted. Okay? Chasing the hot stuff. Believing that, this is a sure thing, a sure bet. This is what I'm going to put into. Not going to work. Not going to work. And then, of course, we have the usual Dalbar study. They do this every year. And they look at the average investor versus the markets, because they'll look at the flows in and out. And at the end of the day, on a $100,000 investment going back over the past 20 years, you would, in fact, have over $120,000 less money than if you had somehow managed to just leave it alone and stay invested. The gap in terms of the typical average equity investor performance and what the market typically does is a huge one that could have a substantial impact on your retirement. In the example that they do, it's a $100,000 investment looking at over 20 years. Okay, the average equity investor wound up getting that up to $280,000 versus if they had just stayed invested in the market consistently, then they would have over $400,000. So now, put some larger numbers on that, right? So what if that was a $500,000 investment, right? That you had $500,000 in your account 20 years ago, looking good, coming up to retirement. The difference in that would have resulted in a $600,000 difference going into retirement versus what you would have had you remained invested in the market. $600,000, that's a pretty substantial number to retire without. But that's the analysis that gets done on a regular basis, looking at the overall average equity investor versus, very simply, the market. Far too often, people get distracted. People read articles like they read in USA Today, or they read this publication or that publication, and then they proceed to make investment decisions based upon that. Folks, that's not the way to do it. Stay diversified, stay balanced, and don't try and concentrate it all into a small range of stocks that you believe are the sure thing, because the sure thing is never the sure thing. Isn't that interesting? Isn't that an interesting article? 18 stocks that are expected to go up by 25%, and if you would put in an equal amount into all 18 stocks, you would have actually lost 26% in a year where, had you just been diversified and owned the broad-based market, you only would have lost about 6%. But you tried to be clever and take the quote-unquote sure thing because that's what USA Today told you, and didn't work out so well. The numbers are dramatic. The studies on this are dramatic. the importance of being diversified and being consistent. Just can't stress that enough. January and December, perfect examples of that. Market volatility is market volatility. There are two sides to it. Unfortunately, you only hear one side, the negative side. December, the worst month, the worst December in like 70 years. You heard a lot of that. Not so much January, the best January in 30 years, that nearly offset the entire decline for December. Didn't hear much of that, did you? Yeah, that's why folks get distracted, unfortunately, especially with the record outflows, right? Record outflows in December. My goodness. Earnings season is this week, too. That's also one of the things that is helping the market as well. You've got a bunch of companies coming out and giving earnings reports, all of which are turning out to be, well, not all, but the majority are turning out to be more positive than was expected. Another comment that I think we made in the last quarter of the prior year was that I think a lot of companies were really trying to kind of dial it down, if you will, or reset expectations. And as is human nature, when you reset expectations, you usually try and reset them to a much lower level so that you can easily hit the threshold. And so that's what we're seeing. So sort of the opposite of what was happening in October and November in terms of earnings and in terms of talking down what the expected earnings would be. You're now seeing where companies are coming in and beating these lower projections, and so the market's responding positively. So interesting, kind of yin and yang on expectations, on profits, particularly when you look at kind of how the market is responding to these earnings. I think a lot of what was going on last year was also these companies trying to reset to lower numbers that they knew that they could easily obtain. And now that they are, in fact, coming in over those lower numbers, now you're seeing the market react in a positive way. So some interesting. So earnings season continues throughout the course of this week and the next couple of weeks. So we'll continue to see the effect that earnings have on the market. The big news, one of the big earnings this week was the folks at Apple reported some earnings that were better than sort of what they expected, again, because they had talked it down so much leading up to that they were then able to hit that threshold. So there's Apple alone, I think, on a Wednesday bounced up like nearly 7%. So some interesting time during, of course, earnings season. It's the bottom half of the hour, so we will slide to a break, and then when we come back, we are going to hit our other two topics. We're going to talk about the Super Bowl. Go Patriots. And we'll talk about the little silly Super Bowl indicator. And then we got to get you caught up on what's going on in Washington and some of the proposals that are out there in response to all these states kind of creating their own kind of thing. There's obviously a move in Washington to try and not create this patchwork of different plans out there. So we'll be talking about that as well when we get back from the break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents. So it's Super Bowl Sunday, so that means we got to trot out the old Super Bowl indicator as we do each and every year. If you're unfamiliar with the Super Bowl indicator, it's one of those stupid market predictor things out there, probably about as accurate as Punxsutawney Phil on Groundhog Day predicting whether there's going to be a short winter or a long winter. Speaking of that, I don't really know how that went yesterday. Groundhog Day just kind of swung by real quick. Anyway, but it is something kind of fun and interesting that we like to mention on the program. Even the Wall Street Journal was getting into it with its Overheard on the Street, the Super Bowl indicator, popularized back when it was almost foolproof. The assumption of whether the big game winning team came from the original NFC or the AFC was supposed to suggest which direction the stocks were headed for the coming year. So if you were a team from the original NFC then and you won the Super Bowl, then that would be a market prediction that the market was going to go up. And then, of course, if you were from the AFC, then that would suggest that the market it would go down. It has been correct 77% of the time overall, so that's not too bad, I guess. But it has been wrong for the past 3 years because last year, sadly, the Eagles won and defeated the Patriots, and they were an NFC team, and the market wound up going down. So that wasn't accurate. The year before, 2017, the Patriots won, and of course they were AFC, and the market wound up going up when it should have been predicted that it was going down. Similarly, the year before that, Broncos won, obviously an AFC team. Market actually went up in 2016. So past 3 years, it has been completely inaccurate, and I think at the end of the day, it's just one of those silly little things that was discovered by the guy by the name of Leonard Koppett in the 1970s, when it had at that point, so 1970s, well, that was 40 odd plus years ago. He realized that it had never been wrong up until that point. Well, the problem, it probably only been about a dozen Super Bowls back in the 1970s. So, but that's where it comes from. So I don't think that changes how you root. It certainly hasn't changed how I root for the game because we want the Patriots to win. And the Super Bowl indicator is just one of those silly things that really has no connection. That's really just more almost of a coincidence, but certainly something to suggest. If you're, purely believe in this kind of nonsense, then I guess you would be a Rams fan. Which are where? Where are the Rams? Are they from St. Louis, or Los Angeles, or yeah? Anyway, so that's enough of that little silliness. Let's turn to some real stuff and talk about what's going on in Washington. Wait a minute. Wouldn't that also be some real silliness too, Joel? I mean, yeah, probably. Anyway, probably even sillier than the supermarket indicator would be the behavior of the turkeys in Washington on both sides of the aisle. But there appears to be some bipartisanship in reference to some of the proposals that are out there that deal directly with your retirement and your retirement accounts. As you know, the contribution limits for 2019 are higher. You can, in fact, if you're under age 50, fund up to $19,000 in a 401k, 403b, 457. If you are 50 or older, you can go all the way up an additional $6,000, so all the way up to $25,000 on that. The IRA contribution limits, and shoot, I remember when these were, a couple of $1,000s. IRA contribution limits for 2019 are up to $6,000 for the year 2019. If you're over age 50, you can actually put $7,000 into an IRA, which is really kind of my point in railing against all of these states that are rolling out their own types of retirement plans. Is you have options where you can put a lot of money in on an annual basis. I don't know why the states have decided to become so paternalistic on rolling out their versions or their plans or their incarnations of basically IRA accounts. It just doesn't make any sense. But that patchwork of approach in a number of states is leading to some conversation in Washington, and there are some bills that are floating around up there that would essentially give employers an incentive to increase the standard minimum default contribution rate under an auto-enrollment situation to 6% from 3%, and then gradually raise that rate up to 10% within a 5-year period of time. And so what that is if you're an employer and you are offering a retirement plan that, in essence, all of the employees are auto-enrolled. See, nowadays, you have to do the paperwork and opt in to participate in your employer plan. A lot of these rules would codify it to make sure that that there is automatic enrollment sort of across the board, and particularly automatic enrollment that forces a much higher withholding or contribution rate from the employee, up to 6% from 3%. It would also deal directly with student loan debt, and this is kind of interesting, whereby the bill would permit employers to make matching contributions to the 401k accounts of employees who are paying off student loans, even if they don't contribute enough to the 401k plan itself to receive the full match. So let me see if I can explain that. So you've got some debt, some student loan debt. You're trying to get it taken care of. You're having to put money towards the student loan debt, and so consequently you're not able to do as much contribution into your 401k. And what the proposal would allow those payments to your student loans to sort of count, if you will, as quasi-contributions to the 401k, enough so that you would get the match from the employer. So let's say your employer matched 50% of every dollar of up to 4%, okay? And you, unfortunately, were only able to do 2% because you were doing your student loans. You could then use those student loan payments as sort of like a credit to get the full employer match, even though those dollars weren't necessarily going into the 401k. That's an interesting one. I have no idea how they're going to keep track of that. I mean, right? I mean, you pay your student loans out of your personal checking account. How is your employer going to how's your employer going to know? I mean, I guess you could certify that. I mean, that just sounds like a little tricky to kind of keep track of. But there'll be some tax incentives to also do that. The retirement savings tax credit, which is a credit that's been around for a long time, they are looking to sort of expand that. Right now, that retirement savings tax credit really kicks in only at very, very low income levels. So part of the proposals on the table is to potentially look at ways to expand that credit so more and more folks would be able to be eligible for that credit. So that's some of the highlights, if you will, on kind of what they're doing to deal with sort of this patchwork that's starting to spring up of different states mandating employers offer 401ks or mandate that employers offer some type of retirement plan to their employees. The other part of these proposals is even more kind of fascinating, and it has to do with getting income out of your retirement account and the conversation of annuities, and also your required minimum distribution. So they've got some things floating around on that as well that are kind of interesting, and we'll get into the details on all of that, but we'll take our last break of the program, and then we come back, we will hit the highlights on that part of these proposals that are floating around up in Washington here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on Super Bowl Sunday. I was listening, heard on television this morning, the millions of people that will go to parties and host parties and eat chicken wings, and it's like the largest consumption of chicken wings on any single day in the year. So if you are enjoying, enjoy responsibly, right? That's the other thing that everybody always says as well, which is certainly good advice. Here on the program, we try and give good advice on financial stuff, so we got to give you the latest on what's going on in Washington. This bill that we're talking about is actually co-sponsored by a Republican, Rob Portman of Ohio, and a Democrat, Ben Cardin of Maryland. So it's got some bipartisan support on it. We gave you some of the highlights in terms of some of the auto enrollment features and matching features if you're paying student loans in the prior segment. The other part of it has to deal with retirement income and required minimum distribution. So on the retirement income side of things, there's this move afoot, and I'm not quite sure I agree with it. There's this move afoot where there's an attempt to try and encourage people to annuitize part of their 401k account by effectively reducing the minimum distributions on the rest of the account balance. So how it would work is, let's say you've got a $400,000 IRA balance, right? And if you annuitize up to $200,000 is the proposal of that $400,000, then you would not have to take out quite as much of a required minimum distribution on that remaining $200,000 that you did not annuitize. The problem with that, and that's fine. The notion behind it, just to explain the notion behind it, the notion behind it is that, as we've talked a little bit about in the program earlier, there is definitely a performance gap for the average investor out there. Okay, we're talking about that a lot at the beginning of the program. Everybody moves out their money out in December when the market's going down, misses out on January, which is the strongest January in 30 years. That problem, and that is a real problem, that performance gap. We were talking earlier in the program about the study by Dalbar. I mean, that performance gap that is $120,000 on a $100,000 investment put in and invested over a 20-year period of time. I mean, those are significant gap numbers. And so the notion is, the suggestion of annuities is, well, for those people that, keep screwing up with their money, then, taking the annuity approach with that guarantee, that is the view in Washington, that guarantee on that annuity side would perhaps prevent people from doing, silly things with their money. And I understand that concept. The problem is that you've got to run the numbers on how that annuity is going to pay off. And the problem with that is that you probably going to be better off just putting it in a money market account, because the returns are not the effective rate of return on any annuity is never more than a couple of percent. And we'll have to do a show that kind of breaks down the math on that, and we might do that in another week or two. But the reality is the math on that only works out to being around 2%. So in terms of longevity and in terms of lower savings, I'm not sure that the government's idea of let's encourage people to use an annuity and stick it in there so that they won't, make a mistake with their money. Well, not making a mistake by going into an annuity is, after all, a mistake anyway, because you basically lock down the rate. You cap your effective return down to a 2% number. I mean, that's not even staying ahead of inflation, let alone taxes. So not sure I really understand the notion there, other than it's, the government being its paternalistic self, and people often making poor decisions with their money. But I'm not sure that's government's role to steer people away. I mean, people should have some ability of making decisions on their own. They just need to make better decisions. But anyway, that's the conversation, and you're hearing that play out in across the political spectrum in various forms and whatnot. The other part, though, that does have some meat to it is that there would also be changes to the required minimum distribution rules. So currently, as you know, the IRS says that, hey, if you're over 70.5, you got to start taking withdrawals out of your tax-deferred accounts, because that money's been taxed, and we want it to be taxed because we want the tax revenue, because we have to spend the money, and also to make sure that the money just doesn't stay in those accounts, continuing to grow on a tax-deferred basis over the course of decades and generations. So that's the other part of it. But under the bill, if your balance is less than $100,000, okay, you could in fact be exempt from having to take the required minimum distribution. And that is a little over half of the balances, or a little bit over half of the IRAs out there. It estimates that it's 53.6%. With IRAs who are 70.5 and older would wind up being exempt from having to take the required minimum distribution. If conceptually, that required minimum distribution, I mean, here's the reality: is if you've got less than $100,000 in your retirement account and you're 70.5, you probably have much bigger problems. Meaning that you haven't saved enough for retirement. So you're probably using that account anyway to just meet life expenses. Not sure that suspending the required minimum distribution gets you much either way, but at least you wouldn't have to worry about, well, oops, I missed my required minimum distribution for this year, so I could be subject to a penalty. But that's part of the provisions that the bill is looking at, is saying if you've got a balance of less than $100,000, then you would not have to worry about taking a required minimum distribution. The other thing that it does, and it's interesting on this as well, it would raise the age for the required minimum distributions to be 72 by the year 2023 and 75 by the year 2030. What's fascinating on that, they're going to raise the age, okay, for something that actually generates income to the government. They're going to raise the age for your required minimum distribution. But they aren't tackling the real problem. The real problem is Social Security and Medicare. And nobody's talking about the fact that those programs, the eligibility ages, haven't changed for well over 30 years. So it's kind of, it's just the silliness of Washington. Just as silly as the Super Bowl indicator. We're going to raise the age for the required minimum distribution, but yet, okay, we're going to turn a blind eye to the real problems that exist that have not had any change in ages. Anyway, crazy. We may have to talk a little bit more about that on next week's program, because we're out of time. We got to wrap it up. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-7 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.